All right, all right, all right. I am going live. I should be live now. Awesome. YouTube says my stream is in excellent condition, which I always like to tell people I'm in excellent condition. Don't mind my... Alrighty. Okay, so um a lot of weird stuff has been happening lately with the markets and the Fed. Um and all of Twitter. Nobody really has any idea, really any clue, kind of what's going on right now. Um, and it's completely irrational. It makes no sense to me why things gyrate like they are right now. This is on March 4th. I've been watching the ticker go like bounce heavily up and down, like a pinball stuck between two bumpers. Um, and it really doesn't make a lot of sense to me. It just really doesn't. So I kind of want to start off today. I'm going to be reading through and going through some resources, and then I'm going to be switching from that to, let's see, where's my thing? There's my thing. I'm going to be reading chapter 26 of this book, Full Employment as the Goal. I think, some of the resources that I'm going to show and some of the stuff that I may show, if you haven't already seen a lot of this stuff, which I think it appears that most people haven't, just kind of what I've been seeing and the kinds of questions people are asking, this might be useful context. And then I should note before I dive into this book, I am not a trained economist. I am not a certified financial accountant or whatever. Um, I'm just a random dude. I don't know what I'm talking about. This kind of stuff has a real impact on people's lives. Fretting, and getting overly concerned about inflation, whatever, you know, that has a very real impact on people's lives. And I am not able to do that in a way that is authoritative. I am an academic. I don't work at the Fed. The people that do work at the Fed are very smart. And, they are just such great people that, to the best of their ability, know what they're trying to do and are frankly operating in a world that makes no goddamn sense. These people, these markets make no goddamn sense. People don't know what they're doing. Um, so that's all I wanted to say before I get started. So we're first going to start off by reading some stuff from my blog, and I'm going to be clicking through to a couple of statements from the Fed, and then I'm just going to be viewing a couple of clips kind of from the Q&A session today, just to get started. And then we'll get into this book, chapter 26, Full Employment as the Goal. And, what is full employment? What is trying to target it? Does that make sense? And can that provide us any context historically, or has that made sense in the past either? The Fed has a very difficult position to be in. So yeah, let's do it. Okay, so first things first. This video from Bridgewater is very good, and this web page is very good, where they call kind of the QE, money printing, whatever, monetary policy 3, and they're basically just trying to look at it, examine it, see what the effects of quantitative easing are in a world that has completely exhausted the ability to lower interest rates. And frankly, in my mind, despite what the IMF has said, negative interest rates make no sense to me. Like that doesn't seem like something that's going to happen. Um, Typically, for those who are unaware, you try to lower interest rates to increase the supply of money circulating through the economy and kind of try to stimulate things. especially when there's an economic downturn. But the problem is, if your rates are already low, there's not a lot of room to go. So that's why there's been a lot of money printing recently. I highly recommend my previous video on titled "The Failure of the New Economics." Examining Keynesian and Austrian schools, for a little bit more about that and the history of it. I had a really good intro for that. But so this is a really good thing from Bridgewater, and they talk about how Turkey had been having some interesting things happening with their inflation as a result of something very similar to monetary policy three. So that's kind of a decent leading indicator, but it's not entirely analogous to the United States situation. The other big news that I think went under a lot of people's radar was a change in the Fed's longer run goals and monetary strategy. I was actually quite a fan of these changes. I don't know if I can explain all the reasons, but this is a really good site that I've linked for this, talking about their statement on differing goals for long run and monetary policy strategy. Basically, they're saying they're willing to let inflation, and should inflation arise and be sustained slightly above the 2% level for a couple of years, they're saying that they'd rather have that happen than try to undercorrect and like not stimulate. I think that's good. At the very least, say there's like 2, 3, 4% of inflation per year. I lose, slightly less than 2, 3, 4%, sitting in cash or whatever. But so you lose a tiny bit of money for a lot of established interests. But I mean, for people who like need jobs and need employment, to eat and be sheltered, that's a whole nother scenario. And I'm in a very privileged position where, I'm not quite as worried about that as a lot of people out there are. I mean, there are a lot of people unemployed, etc. So that's kind of the context I want to approach this from. So when I say like, I'm worried about inflation, I'm not worried about it. The world's not going to end. But it's something that I try to understand these systems and how they operate, and that's the extent of my interest in it. I try to understand these symptoms. They have a marginal impact on me, but not nearly the same impact, that on everybody else. So that's where I come at this from. But so they kept a public commitment to an inflation target of 2%, but blah blah blah. They would likely to aim to achieve inflation moderately above 2% for some time after periods of persistently low inflation like we've historically had the previous decade. And he said it's a flexible form of average inflation targeting. So they're looking to, since we've had such lackluster inflation for so many years, they're saying, oh, well, it's okay if we run a little hotter than 2% because in the aggregate, we are not, doing anything crazy. Yeah, I don't know if that reasoning is solid, but I think the targets that they're setting are very solid. I think, slightly hotter inflation could actually be a very good thing in preventing this kind of cyclical economic downturn that is self-reinforcing. A little bit of inflation keeps people from hoarding money. It keeps people seeking new jobs, and it keeps wages sticky, I think is the right, I might be messing up that word. But that's not a bad thing at all. And it's saying it will not raise interest rates. Now people are starting to think that they're going to raise interest rates quicker than they may have stated. But at this point, that's complete, conjecture. So they're not going to raise interest rates just because the projected unemployment falls below its estimate, unless there are signs of inflation increasing to unwelcome levels. So something that Powell said in today's conference is that, if they see a drastic spike in inflation, their initial mindset is to ascribe that to the reopening. If you have production is at the same level or lower than it traditionally is, yet demand shoots up suddenly when everybody's vaccinated. That would cause a lot of short-term inflation. But they're trying to like get to people is, for inflation of the type that I think a lot of people are sleeping on right now that aren't acknowledging could very well actually happen, would require, due to the Phillips curve, an expectation in inflation to be high or at a certain level for like a series of years. I think that's a possible outcome. But again, this is after getting through reopening and maybe having a couple of months for looking at that data. And this is like a long run trend thing. This is a trend over a number of years. And I think it's entirely possible. I, you know, is it, it's not, inflation is not fun for a lot of people. It's generally considered like, heavy inflation is not considered a desirable outcome, but, we're already all in the same boat. It could happen. Asterisks. Yeah, so I was actually a huge fan of this strategy. They seem to really be addressing financial stability concerns as an important part of the Fed's mandate. I think this has been sorely missing over the past 20 years. This targeting of financial stability specifically instead of just maximum employment and stable prices. I find this much more desirable than maximum employment, but again, what do I know? Not very much. Yeah, so they might consider tightening monetary policy if financial stability risks or other tools are inadequate, blah, blah, blah. But yeah, this part is the really important part. So yeah, they pushed the interest rate up in 2018. I think that was definitely a good move, but inflation ended up being below where they wanted it to be. Yeah, so they're saying accommodation would have been withdrawn later. I think it should have been, so they're just, the statement is essentially saying the Fed is trying to be careful, they're monitoring things. I think a lot of people aren't correctly considering, the dynamics of inflation and how, recent history is not going to be the same as near future. I think a lot of people are sleeping on that. But again, these people are decently smart. They know what they're trying to do. That's not what keeps me up at night. It's not this stuff. So in the new version of the statement, the Fed says it will likely try to aim to achieve inflation moderately above 2% for some time after periods of persistently low inflation. Called this strategy a flexible form of average inflation targeting. Blah, blah, blah. Not specify over what period of time the Fed will seek to have inflation average above 2% or how much over 2% it tends to push inflation as a part of this makeup strategy. So this is the key here. So like say we have 2, 3, 4 years of economic growth. Yeah, that's what this is predicated on, is that we do have growth and there's low unemployment. So most people are employed. There could be a decent bout of inflation for a few years. It's just kind of my thinking of it, because the causative reasons of that A potential unexpected overshoot, might be because a fourth of all the US dollars ever printed were done so in, like the last year or so. I don't, it used to be a fifth, and then I think it increased to a fourth. It might be more than that or slightly less than that. I'm not too sure. But, just a lot of money has been printed. But, you know, the velocity of money, the M2, has gone down in lockstep with the increase in the supply. But what happens if that velocity goes back up as businesses start reopening, people are vaccinated, and the economy starts growing? Well, you could see inflation. It's basically just kind of what that is. This is a really good video from the IMF that shows kind of the basics of why, low but sustained inflation is actually really good for the economy, and why deflation is disastrous and not desirable. But the other question here of, well, people are very quick to say, oh, it's impossible that we're going to have inflation soon because advanced economies have been struggling to even get the 2% inflation that they want over the past like 2 decades. And I think the response to that is, yeah, because they were able to control interest rates in a reasonable way the past 2 decades, according to the Taylor rule and such. They had tools in their tool belt to deal with that. They still have tools now to remove money from the economy. If things heat up too much, they still have good tools for that. But they don't have the same tools that they used to try to flatten the Phillips curve and make inflation less insensitive or less sensitive to unemployment. They don't have those same tools anymore. And the reason is because the reason is because interest rates have been much lower than the traditional prescription, and they were already near zero. They don't have anywhere to go after they're at zero. We're at zero and printing money. So they don't have anything to lower to keep the Phillips curve flat. But, you know, if because they can't lower anymore or shift things around very well, if we start to have more employment, so unemployment goes down and the Phillips curve is steep, it's going to cause inflation because of the slope of that curve being steeper because they can't lower interest rates. There's going to be more inflation. Like that's not contestable. If the Phillips curve is steeper, they're not going to be able to control inflation as well as they'd like. They still have tools, but they won't be able to do it the same way they historically have. And I think that's a key point that a lot of people aren't really aware of, just from what I've been seeing and reading. Um, you know, it would be like saying just because there wasn't a nuclear bomb in 1941, that means there's not going to be a nuclear bomb in 1942 and 1943. The thing that changed in that time was the Manhattan Project. It's a completely flawed form of logic. You know, so yeah. Who killed the Phillips curve? Asked Jim Bullard, an American central banker, at a conference of his peers in 2018. The suspects are in this room. But what happens when the killers run out of ammunition? To keep the Phillips curve flat, central bankers have to be able to cut interest rates whenever inflation threatens to fall, yet they can run out of room to do so. They cannot lower interest rates much below zero because people will take their money out of banks and hold on to cash instead. When Mr. Bullard spoke, the Federal Reserve expected the economy to continue strengthening, allowing it to keep raising interest rates. But that proved impossible. The Fed was able to raise interest rates no higher than 2.5%, but it had to pause in January 2019 and then reversed course. The neutral interest rate proved to be lower than it thought. That left it little room to cut interest rates further when COVID-19 struck. So that's just the chart I was showing on this page. I think this is a much more dire indicator than people realize. This, not having any more room in the money printing. I think that's people aren't appreciating that for what it is. But, again, for the topic of this, the inflation, is more linked to employment than people think because they're no longer able to keep the Phillips curve flat. So we talked about that. What else did I want to talk about? Talked about the change in policy. Talked about why deflation is bad, money supply velocity. There's something I'm forgetting here, but I want to take a quick, look at Jerome Powell's statement today. Basically, their concern, over the past 20 years, let's say, has not been financial stability to the degree that I would be satisfied with, at least. Their goal has been stable prices and maximum employment, which is kind of what I want to dig into today, is this concept of maximum employment. Yes, it's desirable for people to be employed and be able to eat. That's desirable, but is aggressive targeting of that, a potential threat to financial stability? I don't know the answer to that. That's what I'm gonna, at least in part, try to examine today, is through this Austrian teardown of that concept. But so the general feeling that came out of this meeting, I watched the whole thing, was again that the Fed is trying to project confidence. They're trying to say they're going to be stimulative. They're going to be less careful about inflation, but they still said they're going to try to counteract it after an initial lockdown period if it's more than they'd like. But there's a real risk as employment starts to creep back up. There could be inflation that the Fed is ill-equipped to handle.
When people are vaccinated, when they're able to go travel and feel comfortable seeing their family again, there could be a big pickup in activity. Does that mean employment could get back to where it was before the pandemic sooner than you previously thought?
Well, the answer is I would hope so. So let me tell you how we define maximum employment. People focus on the unemployment rate, but it's really much broader than that, because if you haven't looked for a job in the last 4 weeks, then you're not counted as unemployed. You're counted as out of the labor force. So if you look at those who have left the labor force since the pandemic, and also those who are unemployed, then you get a very large number of people who are around the edges of the labor market. And it should be thought of as generally people who want to go back to work. It will take some time to get back to maximum employment. It took us many years to get there before, and that'll really just depend on how strongly the economy picks up once we do get past the pandemic, and once economic activity picks up and hiring picks up. Again, there's a lot of ground to cover to get back to what I would call maximum employment. We want to see wages moving up. We'd want to see that the gains in employment are broad-based, and that different demographic groups were experiencing it. So we have a high standard for identifying what maximum employment is, and we think it'll take some time to get there. But that is exactly the state we're trying to achieve, and we're trying to achieve it, as quickly as we possibly.
So again, a really important takeaway here is that the Fed has very broad goals for what maximum employment are. That means traditionally, let's say the past couple of years, they've been very aggressive. They've been very aggressive even during a roaring economy, keeping rates very low. And that's kind of, they're trying to they're pretty much saying that they're going to keep doing that in the future. Because they want maximum employment, which we're going to unpack that in a second. But again, my opinion is nothing from this Q&A today was particularly novel. I just think a lot of people have been kind of sleeping at the wheel.
Be patient. Cover it before we get to that. The last thing I'll say is this, and I want to be clear about this. If we do see, as I mentioned, if we do see what we believe is likely a transitory increase in inflation, where longer-term inflation expectations are broadly stable at...
So if they believe...
I expect that we will be patient. Cover it before we get to that. At levels consistent with our longer-term inflation expectation increase in inflation, where longer-term inflation expectations are broadly stable at levels consistent with our framework and goals, I expect that we will be patient. Cover it before we get to that.
So again, because supply has gone down and demand might shoot up drastically, you might have a very large spike in initial inflation if people are getting employed at high rates again, and there are there's lots of demand from a corona immune population, but limited supply still because of all the shutdowns. So that would cause a spike in inflation. What they're trying to tell people is they're going to wait and see how that peters out before starting to raise rates, or even they're not even thinking about raising rates, but they're not going to be alarmed by a huge drastic spike in inflation initially. So that was that. Yeah, so the inflation thing is a whole deal. It's not going to play out unless, a big part of this Phillips curve, I want to see this, is inflation expectations. So in the 1960s, some skeptics, perhaps notably Milton Friedman, pointed out the relationship between unemployment and inflation is only as solid as the expectations that underlie it. So historically, because recent history, that relationship has not been very solid due to Fed policy and actually being able to enact Fed policy and having room to enact that policy, that link has not been very strong. But that may no longer be the case now that the Fed has run out of room with the interest rates. So the relationship between unemployment and inflation is only as solid as the expectations that underlie it. If inflation is expected to be 2%, then workers emboldened by low unemployment might demand a wage increase of 3 or 4%. But if inflation is expected to be 10%, then similarly emboldened workers might demand a wage increase of 11% or more. In the 1970s, high inflation persisted despite the high unemployment, precisely because workers' expectations of inflation had risen so much. Economists decided to augment the Phillips curve by adding expectations alongside unemployment as a separate determinant of inflation. So this idea of expectations is very important. In the 1970s, they expected inflation to continue at a high rate because it had previously. We're at the opposite problem now, where people expect that inflation is going to be low because it has been low. But because this Phillips curve is no longer flat, it's steeper. If you were to see people's expectations of inflation change, then you could have inflation as people become employed and the unemployment rate goes down. Yeah, so with that, that's all there is to say about that. Now, finally, I'm going to be able to dive into, not that, but let's see. Okay. A kind of breakdown of the Keynesian derivative idea that full employment is the goal or even desirable. I'm not convinced that that's something that you should be like bending over backwards. You know, this very vague notion of full employment. The foundational justifications for that are not very clear and don't seem very solid to me. But again, you know, I'm just an idiot on the internet. So today, you know, I have no idea if this guy's some crazy Republican or whatever, but I do want to read about his thoughts critiquing this book by John Maynard Keynes, which needs no further introduction. So his critiques of that traditionally predominant philosophy and does, you know, aggressive targeting of that full employment goal, you know, is that desirable or is it destructive? That's what I'm going to be reading today. So, chapter 26, full employment as the goal. The contribution of Keynes that his disciples most often insist upon as valid and permanent is the substitution of full employment as the goal of economic activity rather than the maximum production of classical economists. We shall ask here three main questions about full employment. 1. Is it definable? 2. Is it attainable? 3. Is it at all times and under all conditions even desirable? So 1. Is it definable? Let us begin with the question of definition. The man in the street has few misgivings about this. Full employment means that, air quotes, everybody has a job. It means that jobs for all the people all the time. This naive conception runs into immediate difficulties. Early in 1958, for example, the population of the United States was about 173 million, but there were only some 62 million employed. Therefore, there must have been 111 million unemployed. Yet the official estimate was that there was only about 5 million unemployed. So the unemployed consists only of those in the labor force who are not employed and are looking for work, but he doesn't mention that. But just how was this line drawn between the 67.5 million who were counted as part of the labor force and the 105.5 million who were not? Here's how the U.S. Bureau of Census described it, how it decided. Monthly estimates of the population of working age 14 years and over, showing the total number employed, the total unemployed, and the number not seen in the labor force are obtained from a scientifically selected sample of about 35,000 interviewed households in 330 areas throughout the country. So the estimate of unemployed was in large part based on the sample of only one in every 1,400 households in the country. My purpose here, however, is not to emphasize the probable error in such estimates, but to call attention to the necessarily arbitrary and in some cases purely subjective standards by which unemployment is officially determined. The Bureau of the Census's explanation continues, the unemployed total includes all jobless who are looking for work. How is the number of such persons estimated? From replies to the interviews. What constitutes realistically looking for work? The interviewers must rely in large part upon the realism of the replies. The labor force is not even a constant percentage of the total non-institutional population. In July of 1957, it was 60.6%, but in December, only 58.1%. Some paradoxical results emerge. The monthly report from March of 1958, for example, opens as follows. Employment rose by 300,000 between February and March, while unemployment has unchanged. How could that happen? The layman would naturally expect that if employment rose by 300,000 in March, unemployment would have dropped that much. The government statisticians answer that the labor force has increased by that much. The labor force increases partly by census estimations of the population reaching working age, etc., but also partly by changes in people's decisions. Suppose a man has a good job with a wife at home and a son and daughter in college. He loses his job, whereupon not only he, but his wife, his son, and his daughter start looking for work. Because one person has lost his job, 4 persons are now, quote, unemployed. So unemployment goes up faster than employment goes down. I think this is a really important point. This is a really important point. But I'm not gonna, dig into that for now. I'm just gonna kind of keep going. But that's a really important point. Effective January 1957, persons on layoff and with definite instructions to return to work within 30 days of layoff, and persons waiting to start new wage and salary jobs within the following 30 days are classified as unemployed. Such persons had previously been classified as employed. The combined total of the groups changing classification has averaged about 200,000 to 300,000 a month in recent years. Yeah. So this is mostly stuff just about kind of 1958 when this book was written, about some statistical gripes, but I think we're going to kind of get into the meat of what he's looking into in the next few pages. So I'm just going to try to power through it. So the unemployed increased about 250,000 simply by a change of definition. We get into the same kind of problem. So yeah, so the unemployed increasing by a change of definition, that's a huge issue. I think that's an issue that people, especially the past decade, have vastly underconsidered. They've underconsidered the impact and the long term, most importantly, not the present term impacts, but the long term impacts of those decisions. I think that's what people have been sleeping on. So we get into the same kind of problems with and arbitrary decisions when we come to the matter of working hours. Obviously, there cannot be jobs for people, all the time. We must deduct time for eating, sleeping, rest, and leisure. But how much time? It is customary to think of men being partly unemployed when they are laid off for 2 working days a week. But obviously, they are as much unemployed if they work every day for correspondingly reduced hours. In the United States today, the standard full working week is 40 hours or 5 8-hour days. This is shorter than the standard working week used to be, and in the future it may be shorter still. Obviously, the length of the working week that constitutes full employment is also a matter of arbitrary and conventional definition. Let us see whether we can get some help from the academic economists, and first of all, of course, Keynes. In the general theory, Keynes gives us 2 definitions, neither of which seem to have much relation to the other. On page 15, he gives an involved definition of an involuntary unemployment, which, as I've already tried to show, is invalid. From this, he postulates a state of affairs in the absence of involuntary unemployment. This state of affairs we shall describe as full employment, both frictional and voluntary unemployment being consistent with full employment thus defined. In other words, full employment is a state in which there can be both frictional and voluntary unemployment. Full employment is not full. So I want to, he has a bunch of quotes from Keynes here. I just want to see this thing on page 15 real quick. So let me see if my page numbers match his page numbers. I think I accidentally bought like a large textbook or something. No, it's just the pages are really big. This is a weird book. So now the assumption that the general level of real wages depends on the money wage bargains between the employers and workers is not obviously true. So I don't know that my page numbers are the same as his, which is really unfortunate. Yeah. So that's kind of unfortunate. I'll have to look into that later. But I did want to kind of read through both books and give them a fair shake. But because I can't find the counterpoints, in the original text, I'm just gonna have to keep going with this guy for now. So Keynes says, we have full employment when output has risen to a level at which the marginal return from a representative unit of the factors of production, so land, labor, and capital, has fallen to the minimum figure at which a quantity of the factors sufficient to produce this output is available. So let's break that down. So he says, we have in full employment when output has risen to a level at which the marginal return, so equilibrium has been reached for a traditional firm when like I think it's like marginal price is equal to the marginal cost. Once you hit that, then it's like you can't raise it any higher, otherwise it's undesirable. So when the marginal return from a part of a business, let's say, has fallen to the minimum figure at which a quantity of the factors sufficient to produce this output is available. So basically there's no extra production potential is when full employment is reached. So land, labor, and capital are being utilized to the fullest extent reasonable. When those factors of production are at their maximum efficient position, then he defines that as full employment. So this guy says, I confess I find it difficult to follow this Jabberwocky, but I assume it implies some sort of equilibrium has been reached. One is tempted to ask irreverently, does this mean that Uncle Oscar got a job? Let us turn to A.C. Pigu. Professor Pigu is aware of some of the difficulties we encounter when we try to define unemployment. A man is only unemployed when he is both not employed and also desires to be employed. Moreover, the notion of desiring to be employed must be interpreted in relation to established facts as regards 1. Hours of work per day, 2. Rates of wage, and 3. The state of a man's health. This definition reveals that many subjective and arbitrary elements enter into the concept of unemployment, but we shall see presently that there are many more difficulties even than Pigu's definition allows for. After considerable discussion, Pigu ends up with the conclusion that the quantity of unemployment prevailing at any time is equal to the number of would-be wage earners minus the quantity of labor demanded plus the number of unfilled vacancies. Yeah, that's sensible, but he says it's important to note here that the number of would-be wage earners is not only a subjective rather than objective quantity, but that the quantity of labor demanded and the number of unfilled vacancies are also largely subjective rather than objective because they depend on the changing intentions of employers. If I could get a man to mow my lawn at a certain hourly rate, there would be an unfilled vacancy at that rate. But if the professional gardeners all available demand more, I may decide either to mow my lawn myself or let it grow. So this principle applies throughout the industry. Whether there are unfilled vacancies in a given firm may depend not only on the wage rate at which the vacancies could be filled out, but whether employees with the certain special qualities could be attained. So if somebody's trying to, set up a software engineering position that pays, 20,000 a year, that's an unfilled vacancy. Even though it's not realistic or reasonable and they just keep it on the books, that would affect this definition of employment. So that's what he's critiquing. So this principle applies throughout industry. Whenever there are unfilled vacancies in a given firm may depend not only on the wage rate at which the vacancies could be filled, but whether employees with a certain special qualities could be obtained. In another place, Pigot writes, a contrast is often drawn between situations in which there are more men available for jobs than jobs available for men, and situations in which there are more jobs than men. In the former class of situation, we have less than full employment, that is unemployment. In the latter, more than full employment, that is over, or more briefly, overemployment. So this, I think, it's going to take a while for these points to come back, but the point of what he's trying to get through in this chapter is that the Fed's goal is maximum employment, but that definition is a little bit wonky, and if you keep rates low forever, there are going to be some long-term consequences of that. And the question is, are those consequences more desirable than missing that full employment goal? So that's what we're going to eventually develop into for this argument. He's very wordy, and we're only in part 1 of 3 of his argument here for Mr. Hazlitt. But, I'm hoping that it'll start to make more sense as it picks up. The difficulty of statistical quantification of deciding precisely what the numerical relationship is of men available to jobs available is precisely the difficulty of defining not only what is meant by men available, but also what is meant by a job, particularly when it is unfilled. Let us try Sir William Beveridge and his full employment in a free society. He defines full employment in his opening pages as having always more vacant jobs than unemployed men. The labor market should always be a seller's market rather than a buyer's market. But this is obviously defining full employment as overemployment. Incidentally, Sir William's demand that there must always be more vacant jobs than unemployed men is a demand that labor should always be underpaid. For this condition could only exist if the marginal product of labor were higher than its wage rate, and labor, though fully employed, would therefore be getting less than its potential income. So that's really an interesting point. I think a little bit more economics background would kind of make that a little bit more descriptive. I don't know if I can explain it well without just saying, if you're getting paid less than the marginal product you're producing, you're being underpaid. And if everybody's underpaid, of course you're going to have jobs available. And the only way that you can have more jobs than people is if everybody's unhappy. I think that's interesting. I think I'm not qualified to unpack that. One of the most realistic discussions of the difficulties in the concept of full employment is that of Edwin G. Nurse, formerly chairman of the President's Council of Economic Advisors. Commentating upon the Declaration of Policy in the American Employment Act of 1946, he writes, the phrase, those able, willing, and seeking to work does not define a labor force whose optimum utilization the federal government can, in good economic conscience, pledge itself to utilize all its plans, functions, and resources. In the absence of objective criteria, the word able becomes practically meaningless. Whether a given person is, in a commercial or industrial sense, able to work is a decidedly relative matter. able to work steadily or only intermittently at the kinds of work for which the demand presently exists, only with other skills or without any particular skills, aptitude, or even teachability. Able to work as determined by a doctor's certificate or foreman's report, under standard shop or office conditions, or only with special facilities or treatment. Equally rich in ambiguity is the companion term willing. It was inserted as a gesture of reassurance to those who feared the camel of authoritarianism might be getting his nose under the tent of free enterprise. But does it mean willing to work at such jobs as are available, or only at the job of one's dreams? Willing to work on a time schedule dictated by employers' needs or by workers' convenience. Seeking is, of necessity, the criterion relied on by the Census Bureau in giving us a monthly estimate of involuntary employment. But wanting would be a more apt term for our purpose, since it is a commonplace in the experience of all who have dealt with the unemployed to find not a few persons who want work, may even need it desperately, and who yet are not actively seeking a job because they have been convinced that the search is hopeless. So the plain fact is that the size of our labor force is statistically determinate only when within the limits of quite categorical definitions. So when we speak of full employment, therefore, we would do better to use the term not as the Keynesian zealots use it, and not with any effort at an unattainable mathematical precision, but a loose, common sense way to mean merely the absence of a substantial or abnormal unemployment. If it be objected that this does not, in fact, a definition of full employment, and it is certainly not brimful employment, then I suggest that the term might be dropped entirely, and that the term optimum employment used instead. This would have, among other advantages, that of reminding the user as well as his audience that employment is rather a means than an end, and that its optimum size is relative to other conditions or goals. This last paragraph, I think, is very important, especially with how aggressive the Fed has been targeting full employment, for maybe the past, let's say, 10, 15 years, So, is it attainable? Is full employment attainable? Here, even those who favor the original goal begin to waver. Alvin Hansen, in his definition of full employment and economic policy and full employment, declares that in an economy as large as the United States, it is probable that at full employment, there would be at any one time between 2 and 3 million temporarily unemployed, about 4.5% of the civilian labor force of 1945 through 47. Paul Douglas, commentating on Beveridge's use of a 3% margin for seasonal and transitional unemployment, declared that such a criterion would be fatal in the United States. To use deficit financing to drive unemployment down below 6% is very dangerous. It will tend to do far more harm than good through inflation. So he said, to use deficit financing to drive unemployment down below 6% is very dangerous. It will tend to do far more harm through inflation than the good it will do by absorbing those who are unemployed from seasonal and transitional causes. I think this sentence is really poignant. I can't pronounce that word, but it's really interesting. So when you do deficit financing, is the word, so deficit. So I'm going to read it again, actually. To use deficit financing to drive unemployment down below 6% is very dangerous. It will tend to do far more harm through inflation than the good it will do by absorbing those who are unemployed from seasonal and transitional causes. This is likely to be a sticky point with a lot of people. I'm not an authoritative source for the subject. I don't, fully submit, that factually Mr. Hazlitt is an authoritative subject, on this issue. But I think it points out a very real danger, especially over a long run number of years, where if deficit financing is used frequently and almost all the time, when you actually do have a severe deficit, there's nowhere left to go. And that's kind of where we found ourselves now in 2021 is, deficit financing has been used in this drive for the definition of full employment, but that has meant that interest rates have been much below their Taylor rule prescription, let's say for the past 10, 15 years. And some would argue there has been an asset bubble because of that. Because of this definition, root cause, this definition, the Keynesian definition of maximum employment has driven that stimulative policy that may not have been properly appreciative of what full employment actually is and what the long-term consequences of that could be. But that's a hot take. That is not a fact. That is absolutely not a fact. That is conjecture. That is pure conjecture. Is it unconditionally desirable? So when full employment is seriously discussed, it turns out to be less than full employment. And the desirability of full employment at whatever cost is gravely questioned. Lionel Robbins, quoting the Beveridge definition of full employment as having always more vacant jobs than unemployed men, points out that a state of affairs in which, at current rates of wages, the demand for labor is continually greater than the supply must be a state of affairs in which, in the absence of special restraints, the level of wage rates and hence the level of prices is tending continually to rise. He goes on to point out that even a full employment policy that tried to guarantee a mere equality of jobs and applicants would have to guarantee the trade unions that whatever wage rates they succeed in getting, unemployment would not be permitted to emerge. Professor Robbins concludes that the Beveridgean full employment tends to inflation, reduced adaptability, external disequilibrium, and at a most drastic curtailment of individual liberty. So this is where kind of what I was talking about, the Republican crazy crap. It's coming in a little bit, it's seeping in through the seams, but, the full employment policy is ultimately what, me reading in 2021, I'm trying to unpack. I'm trying to unpack, is the aggressive pursuit of full employment a threat to long-term financial stability? That's why I was really happy. I'm really happy with the Fed's change and the way that they communicated with that. I'm very happy with the Fed that, they're saying, yes, if there's high unemployment, they're going to try to get, people employed. They're going to be very aggressive towards that. But they're also going to be considering long-term stability. But I think, in the wake of the coronavirus pandemic, the pressing problem is obviously that a lot of people are unemployed. They're not worried as inflation as a consequence right now, because the more pressing problem, frankly, is that you have a large swath of the population that became unemployed. But if we were to unpack, why they became unemployed, could it have been that we had a bubble-like system prior to the coronavirus pandemic for, let's say, 10, 15 years, where over-stimulative monetary policy left them little room to wiggle, in a severe crisis? You could argue for that, because you think about 2008, they had a lot of room to drop the interest rate. They didn't in 2019. 2020, they had no room to drop the interest rate, almost no room. And that could be possibly attributed to overstimulative monetary policy. Let's say if they actually did follow the Taylor rule, so let me pull up a chart of the Taylor rule. So so let's say that the Fed did follow the Taylor rule. It's at like 192%, so ignore these charts. I should update them. But so say instead of doing this, because they're getting so, batshit scared of that, they were so scared of that they did this. And, if instead they had stayed according to math-based rule prescription, the interest rates would have been higher. One could argue, let's say the economy did better because of more sane management, or not better, but like less bubbly. There would have been less to pop potentially in 2020. And they would have had a lot more room to lower the interest rate and smooth things out. So the roaring may not have happened, but you also wouldn't have had the catastrophic crash that happened after. And now we're in a very unknowable situation where there's lots of money printing going on. Could that have been avoided if the mathematical rules-based prescription had been followed and not prioritizing full employment over rules-based adherence to sound monetary policy? That's kind of what I'm trying to unpack. I believe, this is conjecture. Oh wait, no, okay, so I need to pull up my thing. So I was talking, but I didn't have the screen up. Okay, so this is the chart I was talking about. So, 2020 is over here. Taylor rule prescription is here. If you're aggressively trying to get full employment because you got so, scared at 08, interest rates at zero for a very long time. Even let's say 2012, when the economy is in good shape and it's roaring, still no raise in interest rates. Still no raise in interest rates. Still no raise in interest rates. Stock market has continued going crazy. Still no raise in interest rates according to the math-based rules-based prescription. All the way up until like 2018, 2019, they try to raise the rates up and keep it there, but they actually have to start going back down because people are already howling, complaining, and scared. And then eventually, when you get to 2020, they've got very little room to maneuver. So whatever wage rates, this blah blah blah, Republican crap here. Edwin Norris, in the article from which I have previously quoted, declares that ideally full employment would be such as promotes continuous maximization of production and real purchasing power for the people, but this definition recognizes that full employment is desirable not as an end itself, but as a means to much broader ends. I'm interested in this. So, but this definition recognizes that full employment is desirable, but not as an end itself, but only as a means to much broader ends. Even the maximization of production must be understood not in the sense of the mere piling up of physical things, but in the sense of maximization of consumer satisfactions. And this includes also, for example, the production or consumption of more leisure at the cost of less desired physical things. If we are talking not of unavoidable means, but of desired ends, then we should recognize that the economic objective of mankind is not more work but less. I hope I may be forgiven for quoting what I have written in another place. The economic goal of any nation, as of any individual, is to get the greatest results with the least effort. The whole economic progress of mankind has consisted in getting more production with the same labor. It is for this reason that men began putting burdens on the backs of mules instead of on their own, that they went on to the wheel and the wagon and the railroad and the motor truck. It is for this reason that men use their ingenuity to develop 100,000 labor-saving inventions. All this is so elementary that one would blush to state it as if it were, so one would blush to state it if it were not being constantly forgotten by those who coin and circulate the new slogans. So basically what he's trying to argue here is that, if you're becoming much more efficient and productive for, we're talking about land, labor, and capital here. If the land and capital become much more efficient and the capital goods, capital machinery become much more efficient, that has no impact on the labor. So the labor can still be unemployed. You can still have very aggressive stimulative policy. But, if the labor is not efficient in its work as the capital goods, or if, you're trying so hard to get people employed that you're not working towards improving the efficiency of those capital goods, overall, in the aggregate, that actually could be potentially not as productive as a self-managed economic cycle where investment was going into different ways. I would like to see evidence of that claim, but this is just some of the stuff we're going to have to get through in this book to get to the more interesting nuggets. So translated into national terms, this first principle means that our real objective is to maximize production. In doing this, full employment, that is the absence of involuntary idleness, becomes a necessity byproduct. But production is the end, employment merely the means. We cannot continuously have the fullest production without full employment. But we can very easily have full employment without full production. That's very interesting. So if it's like the Soviet Union, where you have the manufacturing plant that opens every day for a year, but nothing is made, say they don't have enough capital, that would be undesirable. I don't know how this relates to what he was talking about, though. Primitive tribes are naked, wretchedly fed, and housed, but they do not suffer from unemployment. China and India are incomparably poorer than ourselves, but the main trouble from which they suffer is primitive production methods, which are both a cause and a consequence of a shortage of capital, and not unemployment. Nothing is easier to achieve than full employment, once it is divorced from the goal of full production and taken as an end in itself. Hitler provided full employment with a huge armament program. The war provided full employment for every nation involved. The slave labor in Russia had full employment. Prisons and chain gangs have full employment. Coercion can always provide full employment. Progress of civilization has meant that the reduction of employment, not its increase. It is because we have become increasingly wealthy as a nation that we have been able virtually to eliminate child labor, to remove the necessity of work for many of the aged, and to make it unnecessary for millions of women to take jobs. This is really funny coming from 1958 because that's no longer the case. This is he's living in the post World War II United States manufacturing boom bubble. And that's his entire universe, is where a lot of these other countries do not have good amounts of capital available. They don't have capital goods available for production because it's post-war and everything got bombed. The U.S. was the top dog because nothing in the U.S. got blown up. So at that time it was unnecessary for millions of women to take jobs. He's arguing that's a good thing. He's arguing that the aggressive targeting of full employment is kind of a blind goal when you're not actually looking at how well the capital production is actually working. These means of production, as people are so quick to comment on. He's kind of claiming that full production and not full employment. So he says, we cannot continuously have the fullest production without full employment, but we can very easily have full employment without full production. So he's saying that some of this is kind of being neglected. I don't know how true that is, but I think it's an interesting idea. I think it's one that could be explored more. Especially in the unanswered question that I have is aggressive targeting of a arguably arbitrary notion of full employment, does that have long-term consequences which are underappreciated? Who's to say? So, thank you. I hope you found this video interesting, to kind of see where I'm at on a couple of these topics. I highly recommend checking out my website if you're interested in any of this stuff. And then I should again point out, non-investment advice. I'm not a certified financial accountant, or however you pronounce that acronym, and I am not a classically trained economist. So with that disclaimer, I bid farewell.